The 10-year T-note was up 15 basis points midweek. The 20 and 30-year T-bonds up even more. And then they tumbled. What happened? Hello, members, super savers, and bond course fans. I hope you're having a good week. These are the 3 topics that we'll be covering in today's update video. Why did Treasury yields go up so much in the first half of the week? What changed? And did yields finish higher or lower at the end of the week? Plus, what's on the auction schedule this coming week? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Here's where the 10-year T-note, the 20-year T-bond, and the 30-year T-bond ended on May 24th. And here's where they were midweek on Wednesday, May 29th, up 15 to 17 basis points, depending on the maturity we're looking at. And 15 to 17 basis points up or down can be a big deal in the universe of bonds, as many regulars on our channel know. So, what happened, right? Well, there were 3 primary drivers for the midweek spike in Treasury yields. 1. Several high-ranking Fed officials spoke publicly about inflation stickiness and the need to wait and see on rate cuts, which in other words, sent the same message as higher for longer. The president of the Federal Reserve Bank of Minneapolis, Neil Kashkari, a voting member of the Federal Open Markets Committee, so Kashkari even said that he wouldn't rule out rate hikes. In fact, according to a model from the Federal Reserve Bank of Cleveland, inflation does not fall to near to 2% until mid-2027. Taken together, these model-based forecasts indicate notable upside risk to forecasts that see inflation back to 2% by spring of next year. Second, demand for the 2-year, 5-year, and 7-year auctions that happened during the week was, well, weak, meaning there weren't enough interested buyers. Weak demand at auction generally translates into lower prices, and that in turn means higher yields. Perhaps the market is losing its appetite for the hundreds of billions of dollars of new debt that the Treasury is issuing on a weekly basis. Whatever the deeper reason, the lackluster results from the 2-year, 5-year, and 7-year auctions impacted not just these maturities, but also pushed the yields on the 10 and 30-year Treasuries to their highest closing levels since the beginning of May. Third, the market had expected Friday's PCE report to show little progress with inflation. Now, as some of our Diamond Nest Egg regulars know, our country uses 2 measurements of consumer inflation. The Consumer Price Index, also known as CPI or CPIU for short, is published by the Bureau of Labor Statistics, the BLS, and familiar to many of us because I-bonds and TIPS are adjusted to inflation at regular intervals based on this measure. And the Personal Consumption Expenditures Price Index, or PCE for short, is calculated by the Bureau of Economic Analysis, the BEA. The PCE is the Fed's preferred inflation gauge. Now, CPI and PCE do measure inflation in somewhat different ways, and it can be sometimes confusing to understand the difference between the two. If you're interested in learning more about CPI versus PCE and why the Fed prefers one over the other, then drop a comment below and we'll try to work on a video on this topic for you. In any case, the PCE numbers did bring a tiny bit of a silver lining to the overall picture, and many market participants breathed a sigh of relief because they had been fearing the worst. The PCE would show inflation sticking or even accelerating, which brings us neatly to the next section of this video. Now, because the PCE report released on the very last working day of the week showed that inflation might actually be easing, bond yields came down a bit from the midweek spike. And as a side note, another event that happened midweek was that the Treasury started their new buyback program on May 29th. That event didn't influence the overall Treasury and bond markets in any significant way, which was in line with what we were expecting, but it did surprise some market commentators who had expected more. We linked this Treasury buyback video from a few days earlier below this video in case you missed it or want a refresher. So, back to bond yields specifically. As we so often do at the end of a week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday. And here's where yields stood at the end of the previous week. At the longer end, the 7-year T-note, the 10-year T-note, the 20-year T-bond, and the 30-year T-bond were all up a few basis points versus a week ago. However, most of the bond yields at the shorter end were generally down by a few basis points this past week. The 3-month T-bill was unchanged. So quite a mixed picture, which also led to our currently inverted yield curve to become a bit less steep. This is financial speak for saying that the curve remains inverted, with shorter maturities paying more than longer ones, but that the difference has been reduced by a few basis points. In the grand scheme of things and relative to the beginning of 2024, though, bond yields are nearly all still up, as you can see from this table comparing Treasury yields from this past Friday versus January 2nd. This row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. The 1-month and 2-month T-bills are down a few basis points, and the 3-month T-bill is unchanged again. Otherwise, rates continue to be higher overall across all the other maturities, and noticeably higher on the medium and long end. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Resource Center website here. All sources are linked below in the first pinned comment. So, that was a recap of bond yields from last week. Now, let's take a look at the upcoming week's auctions. Things are relatively quiet on the auction front this coming week. All the weekly T-bill and CMB auctions are happening as usual, as you can see here. Otherwise, there are no other major T-note, T-bond, or other auctions. The BLS will release the jobs report for May on June 7th. So, depending on what those numbers will show, this upcoming week may or may not be a big week for bond yields. As always, stay tuned on our channel. We'll be reporting on this and any other news that may be relevant to our fixed income community. So, I hope you enjoyed this video and learned something new. And if you did and want a deep dive into how to invest in bonds and build a bond portfolio while yields are still attractive, then check out this video here on one of our 2 recently launched bond courses. Or join us in one of our live sessions this month. Our live YouTube member Q&A will be on Monday, June 17th at 5:45 p.m. Eastern Time, with highlights of the 5-year tips and 20-year T-bond auctions. And our live Bond Masters course session will be on Monday, June 24th at 5:45 p.m. Eastern Time, with highlights of the 2-year, 5-year, and 7-year T-note auctions. The replays will be available afterwards as usual in the respective member and course areas. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership. All right, member Super Savers and bond course fans, good luck to everyone who's planning on buying at the upcoming week's auctions. And see you again very soon with more brand new wealth building content for your financial journey.